You open an investing app, tap buy, and suddenly you own stock. But what actually happened? Where did your money go? Who sold you the shares? And who decides the price that flashes on the screen every second? Most people use the stock market without really seeing the system underneath it. So here's the core idea. The stock market is a giant marketplace for ownership. A stock is a small piece of a company. If a company is divided into 1 million shares and you own 1,000 of them, you own a tiny percentage of that business. That ownership can matter because if the company grows, your shares may become more valuable. Some companies also share profits through dividends. But beginners often misunderstand one important thing. When you buy a stock, your money usually does not go to the company itself. There are actually two different markets. First is the primary market. This is when a company creates shares and sells them to raise money. An IPO, or initial public offering, works this way. Investors give money directly to the company, and the company uses that cash for expansion, hiring, research, or debt. But most stock market activity is not that. Most trading happens in the secondary market. That's where investors trade shares with each other. If you buy one share of a company today, you're usually buying it from another investor who decided to sell. Your money goes to them, not the company. That raises another question. How do buyers and sellers actually find each other? That's where the infrastructure comes in. You place an order through a broker. Your app might look simple, but the broker connects you to exchanges and trading systems where orders are matched. Exchanges like the New York Stock Exchange or NASDAQ are basically enormous marketplaces built for matching buyers and sellers extremely quickly. Now imagine you want to buy one share, trading around $100. You have two common choices. A market order means buy it immediately at the best available price. A limit order means only buy if the price reaches my chosen number. Behind the scenes, every stock has an order book. Buyers submit bids, which are offers to buy at certain prices. Sellers submit asks, which are prices they're willing to accept. Maybe buyers are offering $99.98, while sellers want $100.02. If someone agrees to the seller's price, a trade happens. That trade becomes the latest market price you see on charts. So the stock price is not chosen by the company, the government, or the app. It emerges from constant negotiation between buyers and sellers. Another hidden layer is settlement. Even though trades appear instant, the actual transfer takes more time. After the trade executes, clearinghouses make sure the buyer delivers the money and the seller delivers the shares. In the United States, stock trades usually settle one business day later. Execution is fast. Final settlement is separate. Now, why do prices move all day? Because markets are constantly updating expectations about the future. If investors believe a company will grow faster than expected, more people may want to buy the stock, pushing prices higher. If investors fear weaker profits, competition, lawsuits, or economic trouble, prices may fall. And markets care about surprises. A company can report record profits and still see its stock drop if investors expected even better results. Interest rates matter too. When rates rise, safer investments become more attractive, and future company profits look less valuable in today's dollars. So when people say the market is up, they usually mean indexes like the S&P 500, which track large groups of companies rather than every stock individually. So the stock market is really a giant system for trading ownership. Companies create shares, investors trade them, brokers route orders, exchanges match buyers and sellers, and prices continuously adjust based on what people believe the future will look like.